emailed right out to you guys.
Yeah, sorry about that last week.
No,
I
it's
was just such on autopilot for it. I was like, oh no, like.
Well, I mean, it was only. I mean, fortunately, it wasn't due that night because, yeah, like I went and laid down with my kids, put them in bed, and then realized at like midnight, oh shoot, I didn't get that out. So, yeah, no, I will not do that tonight. Okay. So week 9, group discussion on the Right Now Technologies case study will commence. And this is a pretty short, discussion, presumably with a bit of analysis that went into each of these questions. So, but it will start off right off the bat. What value would you place on Right Now Technologies? And I guess there's probably 100 different approaches we could have taken to this. I'm just, as I'm asking the question, realizing my approach to this was kind of maybe backwards a little bit, but I'll turn it over to you guys first to discuss, or maybe we all want to put our own answer. I don't
know. Well, let's see. So if you see what's on my screen, I just kind of went for my fall 2 one if they've got those kinds of numbers. And so they had that list. I forget which exhibit it is.
I think it's exhibit 4.
That had all the revenue multipliers.
Yeah.
And then
I got the same numbers you did.
Yeah, so, I did too.
Okay. So did that average?
I did the exact same thing.
Okay.
What's weird? Oh, go ahead.
Oh, well, I was just going to say with the proposed okay, yeah. So let's see, where was okay, so are you talking about these numbers up here under projected values? The 87,000, the 122,000, and the 146,000?
I'm talking about the proposed run rate multiplier range that you outlined there and the corresponding valuations.
Okay.
Yeah.
Because that's like part of what I felt was like coming out of this discussion. It was like the acquisition company, the company that was wanting to acquire, like was offering more than what it was worth.
Right. Well, that what I couldn't figure out is the way I'd understood it from previous cases is that you could typically get better valuation in an IPO, and nothing I'm seeing from Exhibit 3, which I admit I was having trouble comprehending a little bit, but ultimately you get these enterprise value over revenue numbers, and none of those are close to the multipliers, the multiplier range that, I mean, one of them falls within the multiplier range this company's basically considering, given the same analysis that we all sort of did.
All right.
Like, I mean, are you guys seeing the same thing if you go to Exhibit 3? Am I looking at that right?
All right, let's see. Exhibit 3.
And it's kind of the last, on the second row of data, the last two fields, enterprise value over 2003 revenue and enterprise value over 2004 revenue.
Okay, and then that's where you're seeing, because you got some height like that SAP.
Yeah, it's the only one that falls in the lower range of what we're kind of right in the middle of the range. We'd be looking at, but the majority are between 3 and 4 times revenue. So just that kind of made me feel like I'm missing something here, like, because clearly the case makes it out as though the IPO is this attractive alternative that the investors are, that the venture capitalist people are maybe going to prefer over the private or the merger and acquisition.
So my gathering from it was like these guys are offering way more than it's worth, but then it's a question of are you wanting to like give up your company to someone who operates in a way that like you don't like they're happy about this new form of, you know, technology that they're offering, you know, basically which is becoming the main form of technology these days, you know, it's a subscription, you know, subscription use of a software, right?
Yeah.
And so they know that if they send it to acquisition, most likely either that company will probably like dissolve it or maybe they'll run with it, you know, utilizing it. But it's like this like selling to the enemy thing is what I was gathering from some of the reading. It was like,
Yeah, and I definitely picked up on that. Yeah.
so it wasn't really a question like they were offering more than the IPO would give, but they really want to do that. And then it was like balancing that with what obviously the investors want. Like, are the investors, you know, are the investors that they already have driven by the same goal, or do they really just want to make the money, you know? And then like, so, or at least, so my takeaway of this uh, case analysis was that balancing that actual, like what you want to see the company do versus, you know, how much money you can get like right now.
Right. Yeah.
Yeah, and to me, it kind of seemed like he still wanted like to be invested in the company. He didn't want to just give it up.
And he
It seemed
would
like
too. And he would, even the IPO thing would make him give it up a lot.
Yeah.
We'll get into that.
Yeah. Yeah. So I mean, it is interesting. Like, they're absolutely overvaluing it if they're willing to do it 2 or 3 times the prior valuation. There's nothing comparable in any of the other adjusted multipliers that we're seeing. So yeah, so I was really thinking back to that previous case where they, you know, the potential in an IPO was pretty significant. But I see what your calculations highlight there, which is if you actually look at the example merger and acquisitions multipliers and compare those to those IPO multipliers, in fact, the IPO multipliers do trend better than what we're seeing with this potential sale. Yeah. That kind of makes me reconsider the well, I guess it yeah, definitely puts it more into the framework of what you're talking about, Brando, where it's a trade-off between a huge buyout versus a you know, maintaining control of the company and bringing more jobs to Bozeman or whatever.
And that was the other thing, was the bringing the jobs to Bozeman.
Yeah. Interesting. Yeah.
Yeah, if he chooses the acquisition route, there's no guarantee that they will keep the location in Bozeman because, like it said, that's not like an ideal location of what people think of for like a company like that.
Oh yeah, I figured first thing they would do would be relocate.
Yeah.
So to get back to the answer to number one, well, let's see. And then rather than a single number, how did you come to that conclusion? Okay, so number two is really just a continuation of number one. So that's what I'm having trouble like deciding. It's like, do we want to answer the possibilities like based on typical, you know, valuations? We have the, you know, these projected values, or based off of the offer, we have these other values, or how do we want to show our answer to that?
I think you might be looking based off of number two, where it's like a range of values, looking for how we would value it based off of like the route we pick. So like IPO value it different, and the acquisition is a little different. I think that might be what it's looking for.
Yeah.
Because this, my top right one is basically, you know, IPO and or what am I trying to think of? VC investments, and then obviously that's the bottom right one is the IPO or acquisition.
Right.
So that's the you're using the 2.44 multiplier for the top.
Yeah.
Okay.
Yeah.
Yeah.
Which, and then even if they wanted to give range, I mean, so you could use, we could use the, easily enough, we can use the lowest to the highest in here in these revenue multipliers as well.
Yeah. So I should have done this, but I want to take that same model you've got there and then just use the averages from the exhibit 3. So I'll kind of whip something up there, but I'm expecting that average to skew a little bit higher, maybe as high as like 3.2. I'm just going to assume 3.2.
What were you doing?
Well, just I'm kind of curious what the IPO route would be using the enterprise value over revenue.
Oh, got you. Let's see, what's the lowest on this? There we go.
Oh man, I'm a pretty good guesser, guys. It's 3.24. It's the average for. Right. $60 million. Oh, shoot. Yeah, man, I forgot all my statistics. So I used to know how to build, like, you ran that equation and it would give you the, like, the 95th percentile and stuff.
Mhm.
Seems like that would be the range. I would want to figure out how to calculate my 5th percentile to my 95th percentile and give that range.
Yeah, I could really, it'd take me a moment. I could look up my statistics stuff. I mean, I've saved all my spreadsheets, but it would take a while to find them.
Yeah, no, I'm gonna kind of ballpark it. I'm gonna go 1.2 up to 4.5.
So basically just what I got as far as going with the revenue multipliers, and then running on the run rate just to highlight one of the example numbers. You're looking at a value of anywhere from 11 million to 217 million, just based on the actual low multiplier and then the high multiplier.
My rough thing was, yeah, basically the same, 72 million to 270 million using the IPO data.
Yeah.
So we're basically talking 100 million to 200 plus million as a range.
As far as the range answer.
Yeah.
Yeah, so I mean, in the question number 1, it's like we really need to discount a little bit this amazing offer, considering the lack of control we have after it's done, and look at understanding what the market would actually pay for us, because obviously this competitor has an incentive to overpay to get us out of the way so we stop eating up their market share. So I'm thinking for question 1, I want to go. I think I want to go to like 180 million. Well, I guess maybe just split the difference between our averages. Would that be 150 million?
That would be $1.50, yeah.
Yeah.
Mhm.
What's a 60% stake in $1.50?
I don't know why I can't just say that right off the top of my head.
I know it's out of math. 90
90 million, yeah.
Yeah.
So that's pretty close to 100 million. That sort of 9-figure income.
Yeah.
Yeah. Yeah, I'd say that's. Oh, that's interesting. If Greg's investors seek a 30 to 50% internal rate of return, what exit value will they expect? And actually, so I'm going to up that to 30%, change this to 6.23.
Forget the formula on internal rate of return.
I think it's just future value, right? Well, that's what I did.
Oh, that's. I found a calculator calculating it the other way.
Oh.
A 30% internal rate of return. What exit value will they expect? Okay, so for them to get a 30% internal rate of return, I calculate they would need the investors would need to make $107 million.
Is this
Total.
based off of their $32 million worth of investments? Or
Yeah, it's based off this 16.4 million in 1999, which would be, I believe, in there for 5 years, and the 16 million in 2000, which would be in for 4 years, assuming we sold in 2004. Yeah. And so I just did the future value calculation with the rate as 30%. The periods is 5 for the 1999 or Series A round. So 5 periods, no payments, and then negative 16.4 million.
did future value is what you did?
Yeah, future value. So what's the future value of 16.4 at a 30% internal rate of return over 5 years? And you got to make the you got to make the 16.4 a negative 16.4 in the equation for it to come out positive.
So how would I do that right here? Just to try to remind me.
Let me look at yours real quick.
I just pulled up a.
Okay, so rate. How do I lock it on yours? Okay.
You just
on
click
his
on the.
name.
Okay. So rate 0.3.
Yeah.
Periods 5 for the first Series A round.
Oh, okay.
0.
Payment 0.
Yeah. Present value 16.4 million. And I think we type blank.
And then it was negative 16.4, right?
Yeah.
Yeah.
Negative 16.4.
Okay. And then for the next one.
The next one, same thing, except 4 periods.
What? Oh, dang it. All right, so it would be 30% again.
Yeah.
4 periods, 0 payments, and then how much was it? Was
16 even.
It was 16 again.
Yeah, 16 million. And let me see if that's what I got. Yeah, I think that's what I got. So let's check those periods first. Does that sound right? So 1999 to 2000, 2001, 2002, 2003, 2004, 5 periods I count. 99 to 2000, that's 1, 2000, 2001, 2, 2000. Oh, geez. 2000, 2001, 2002, 2003, 2004, 5 periods. That sound right?
Yeah.
Yeah, okay. And then 4 periods for the investment that came in the next year. So we kind of got to do some algebra here, but we have the total, and you're working on the 50%.
Yeah.
So that's going to give us the total value, and we know that 60% of the company is owned by, anyway, so it's going to be some interesting algebra we'll have to figure out.
Oh, because theirs is just a percentage. Yeah, I know how to figure that out once we get.
Yeah,
once we get
this. And I think we're going to have to do some guesswork or some variations on that because we don't know what of the remaining 40% the investors own. Like, does that, like they may only own 20% after you account for options for the other, management team and stuff.
Mm. So, because they own 40%. Well, it was pretty cut and dry. It was just saying 40%. Like, there was nothing. I mean, it is split between multiple investors because it said, like, the first one was led mostly by the one group and the second one was led mostly by the other group, but there was no specific numbers. So, like, even, like, just so you know, like.
Actually, that's a good point. Yeah.
It was just a VC aggregate, is the way I treated it.
Well, so let's look at that. So after the Series B round, they invested an additional 16 million. They valued it at 129, and we can fill in the gaps there a little bit. So I'm gonna just figure that out real quick.
So it would have to sell for. These are what it would have to sell for. Numbers below.
Okay, between 266 and 513 million dollars.
Yeah, because you just divide it by their percentage that they have.
Right.
And
you're assuming 40%.
Yeah, I just went on the 40%.
And I think it's a little lower than that, though.
What's lower than what?
I think the VCs don't own 40% of the company. Because certainly some of those early employees he brought on had some sort of ownership stake, don't you think?
You would think that, but they didn't say that. So I usually just like negate unmentioned information personally.
Well, I think you can imply, the 60%, and then the 2 investment periods. So like you take the first round, for example, and you could see what his stake would be in the first round of investing when they put in the 16.4 million. Anyway, so I think we could figure, but I don't think it's worth the energy. But yeah, so I think I would. My preference would be to drop it down to at least 30% and assume a 10% pool was saved for management, if that's okay. But
yeah. So
VC equity or whatever.
Yeah. Actually, you know what? They'd actually have to sell for higher.
Yeah, they'd have to
Yeah.
sell higher.
Yeah, because that's right. Because if they own less, it's got to sell for higher to make up because their investment was still the same.
Right.
Yeah.
Yeah. So, and I don't know why that question seems completely out of line with the way the market's going. I assumed like a 25% IRR would be more than sufficient for them. But then, understandably, those numbers are averages or whatever.
Mm-hmm.
But it's on Exhibit 5, private equity, VC returns, 5 years. You know, like back in 99 and 2000. So that is interesting, I guess. When they got in on this, the IRR was hovering just below 50% in 1999 and 2000.
Mm-hmm.
But since then, it's gone through a significant drop. And by 2003, it's at 22% on average. So I assume 25%, but. So what would they have to grow their sales to if they were going to get a multiplier of, say, the 2.55 or whatever the multiplier you had there was? What would their revenue have to be to get those kind of
to get
yeah, wouldn't you just divide that by 2.44?
yeah, yes, yeah. Just for that, oops, that one. This was a
Yeah.
145 million a year that had to be
Yeah.
having in sales, and
Quite
what are
the
they?
jump.
Yeah, they'd have to nearly triple. They'd have to basically somewhere around triple it.
Yeah. What are companies doing
Well, the one main competitor, the one that they really wanted to compare themselves to, except that their sales just weren't as good, but they were the most comparable.
Are you talking about Salesforce?
Yeah, I think their sales were up there. Let's see, where's their statement? Their statement's towards the.
Yeah, it was like 90
Towards
million.
the. Let's see here. Revenues. Oh, maybe I'm wrong. They're just up to 50.
I say they weren't that much higher.
I thought for some reason I thought they were way higher. I was remembering wrong.
No, because when I was looking at like their revenue and their expenses and costs, just to kind of compare how they were, like this company that's filing for an IPO compared to right now, they weren't that different. Like, so if you were to compare right now to Salesforce and say, hey, let's do an IPO, because look at Salesforce, they're not that much higher than right now, and they're doing an IPO.
And that's why they figured that, or that's why they talk about the idea of waiting until they sell, because it's so similar.
The other thing is we're using an average multiplier, but you would. It's almost like you shouldn't use it for your. You should, I guess, you should plan to go to an IPO with a company that's like really strong and expect a really good multiplier, like a industry-leading multiplier. So,
how do you do mean again? Mean was, it's not mean apparently. Oh,
isn't just average?
No, it's not average. It's not. Well, I mean, it's a form of average, but it's. To the internet.
Are you looking to calculate the mean?
Yeah.
It is average. The average formula in Excel.
Oh yeah, that's what I thought. Anyways, you just do the average formula.
Oh, because median is what I was looking for then.
Okay,
My
that's
bad.
median. Yeah, it's the median. It's just equals median.
Oh,
Median was what I don't know why I was thinking. My bad. Just because it looks like numbers are obvious. Well, that just increased it just barely. So the median was 2.75. Because I could tell the numbers like leaned more in favor of the higher.
Mm-hmm.
like the outliers are on the high side. Is that what that means?
The outliers are on the low side.
Oh, okay, gotcha.
So most of your numbers are on the high side. You got these few outliers that are way low.
Creating a long
Yeah,
tail.
like that 0.23 or 0.78. I was a little surprised by.
Yeah. So then that's what it brings it closer to 2.75. But still, that increased the numbers a little bit, but
And that's for the mergers and acquisitions. If you take the averages from the 2 years of data on Exhibit 5, I believe, and I'll just do that real quick. You get an average of 3.2 and a median of 3.15. So just as an alternative to look at.
no, okay.
Where did my graphs go? Can I get those numbers off the other tab on your worksheet?
Which ones?
The
Oh, these?
yeah, those ones.
I was gonna put that on our little worksheet or on our answer thing. I was just gonna.
Oh yeah, paste it right there. I'm just gonna take the range there. 355 and 685. Just so you're, when I use the averages from Exhibit 5, the IPO numbers or the public company numbers, that you're looking at 109 million in revenue versus a range of 109 million in revenue to 211 million in revenue, so just a little bit lower.
If they're using that multiplier instead of the
Yeah, just the 3.24 is what I use.
Gotcha.
Yeah, so it's kind of interesting to look at what it's hard to see where they get to that in 5 years.
Yeah, that's.
And the number changes, like we'd have to go and extend the, depending on when we expect the sale to be, we have to add those periods into our model. So I just don't. It doesn't seem like they're going to get a 30% return on this investment, given any of the valuation.
Oh, yeah, not immediately, no.
Yeah.
And but see, then we're talking though. Here we are with this offer here, from that company, which is offering them at least a 30% internal rate, like upwards of. So that's that other thing. It's like, so then it just like part of, I feel like what this paper about is like evaluating what page your venture capitalist investors are like on with you, like what page they're on with you.
Yeah.
What's their goal too? Do they just want to see that money return like right now because it's offered right now, or did they have a vested interest, or did they actually care about the overall goal of the investment?
Yeah.
And so I did this was math. This math, like obviously in an acquisition doesn't apply, but I was like, okay, say they're like one of those crazy IPO situations where they just valued so high. It's just like that random hypothetical, and looking at their value and what would happen if they went into an IPO, and just the amount of ownership he would lose, like, you know, there's his 60% ownership at the low range would turn into 30%, and at the high range would turn into 20%. So it's like obvious that he would end up most likely losing control, or like he would still have like a seat on the board, but the odds of him having the full control he wants to have, if it sold as an IPO that high, would not be there.
But I could see him being able to negotiate with them and to retain some of the, because my understanding of the purchase attempt was that they weren't just trying to buy this company to dissolve it and get rid of a competitor. They actually wanted to purchase the technology and the market share and just the type of service that was being offered. So you could imagine that you could tailor the purchase agreement in a way that would allow you to remain located in Bozeman and kind of retain some of the sort of corporate culture features you wanted. The other thing that I noted was that this isn't a cash purchase, right? Like it's stock options.
It's stock options, but it's still like being bought out at that value. So that was the other interesting thing. It's like he would retain a percentage of ownership that would even compare to these numbers in the acquisition. But because it's stock in a larger company, he would lose, like, other than any negotiations that you just mentioned.
Right.
He would lose actual, like, controlling stock, you know.
Right. Yeah.
So he'd have stock. He'd have a percentage of value that like relates to, you know, what we see here, this 30 to 20%. But whether that has any controlling value is
like
dependent on his negotiations.
Equity in the company after that is what you're saying.
Yeah, and the equity would be tied into the larger company, not the smaller company.
Yeah. Yeah.
No, I mean, that's just what to consider of that fact.
Yeah. But either way, he stands to walk away with, $100 million worth of, if they get that higher valuation, the 387 million.
Yeah.
That it's still, though, just the whole like the market trends and everything.
He'd walk away with 77 million.
Oh, sorry, what was that?
His value, the 20% of 387 million is 77 million.
Isn't it six? Doesn't he own 60%? What am I doing wrong here?
Oh. Where'd that go? Oh yeah, because if it's sold out for that.
Yeah, so he'd get 60% of that buyout, right?
Yeah, that's true. Yeah.
So I'm showing you make $232 million.
Yeah, that's right. That's my bad.
Yeah, with the new company. The investors, I show the VC firms would make $106 million if they were getting a 30% internal rate of return. They would come out with $106 million, and there'd be a pool of. Oh no, that doesn't work at all.
Wait, if they got 106 million.
No, yeah, something's wrong here.
Well, that would just be no. That's right. Yeah, because what we even figured, this company would have to sell for it. Yeah. So essentially, if they can sell the company for that amount, the VC investors would get the 30%. Like if they were hoping for a 30% internal rate of return, that's what they would get. So your number was right.
Okay, yeah, I was doing my math. So there's a $48 million pool that would be split between the additional managerial team that had been brought on. As what I show as sort of the leftover pool.
Yeah, I got you.
Yeah, this buyout's looking better and better to me. If they can get the times 3 multiplier, or the 3 times the previous valuation. I mean,
Yeah. Well, yeah, and that's the big debate, like, because the money's there, like it's valuable.
yeah, and it's what's their run rate? 50 million or 60 million?
50.
50 million.
Their projected for 2004 is 60. Their current run rate is 50.
Oh, right. So their current run rate, that'd be a 7.74 multiplier, which would be industry leading. I don't know. That's making this offer sound pretty good. I think I'm taking that offer.
When I did the case study, at first I was like, oh, well, maybe they should just do another IPO. And then after doing all the math, I was like, no, buyout is better. Let's just do the buyout. Because I also feel like the IPO would just be so much risk going into it again.
Now, would he be able to sell his shares immediately and walk away? Like, would they have like a buyout clause or something?
I'm sure. I mean, they didn't talk about that on this, but typically when you get into things like that, there usually is like a clause on how much of it you can sell, how soon.
Yeah, usually they make you wait a year, 3 or whatever.
Yeah.
And that's something we don't see at all, is any stock performance of this company.
Yeah, no. So that's your, and so, for example, that you just mentioned that. So if you haven't turned in your analysis yet, you could talk about that being, say, like the weakness to your hypothesis. It's like, yeah, they should sell it, but then it's like, okay, the weakness is how well are their stocks doing? Have they been performing well lately? Have they been performing horribly lately?
Yeah, I need to put that in as one of my questions. All right. Provide your analysis of each of the options Greg is considering. Based on your analysis, what should Greg do? Considering Greg's goals as well as the goals of everyone else who is involved in the venture. And we've been mulling over that a little bit.
That's what we've been talking about.
My vote now is
Let's
try
see.
and sell the company.
So, like, even when considering the acquisition possibility, he can always negotiate in that to keep the location in Bozeman, so he can still try and provide jobs for people there. Because I know when the company I work for was bought out, they negotiated to keep us here in Salt Lake instead of relocating us to St. Louis.
And I would say I think it kind of has to be in that higher range. Like, I think for this to work, it can't. They need to get that 387 million.
Yeah.
Or else the VCs don't walk away with their 30%. I'm just letting you type that out there, but I think I'm ready to do our recap whenever you guys. Do we need to talk about this for another 40 minutes to fill this time, or think we
No.
Yeah.
I think we only had 7 minutes left, really, don't we?
Oh shoot! Have we been talking that long? My bad, guys.
Yeah.
I thought we started at 8. Slow.
Maybe that's when you started recording, but we did start around 7:30.
Yeah.
What was the O? You got it. I don't know.
Yeah.
We have stuff on there.
Yeah, I can roll with that though. Yeah, but basically, if they can get the 3 times multiplier, then we can get within 5 years the VCs a 30% return on their investment, which would be stellar compared to industry averages at this time. And the whole stock thing is just such a big question mark for me, though, because like those VCs, they don't want to exit with stock, right? They want to exit with cash that they can, show their investors they're bringing in the. Anyway, but there's got to be some sort of like buyout component of that, because presumably the buyer of the company would know a portion of these investors and former owners are going to be looking to exit with cash, so they would be able to structure the deal in such a way that, hey, we'll buy back a certain amount of the shares at this rate upon completion of the sale. Or anyway,
or that they
I'm
could
not
sell
gonna
a certain amount. But yeah, there'd have to be negotiations to that regard.
Yeah. Okay. I guess, are y'all ready for a little recap?
Yeah.
Yeah.
Remember to make your screen the main one.
So I'm going to share my screen, start sharing, and I've clicked on your screen here, so I'm going to unclick that. Now we're sharing my screen.
There you go.
Here, and we are about to start our recap. All right. Okay, so this is a recap of our group's Right Now Technologies case study discussion. Pretty quick recap. We'll just run through these questions real fast. What value would you place on the Right Now Technologies? We discussed this, and collectively we're operating under the assumption of like if we had to take the company to market an IPO, or if we were selling at industry average merger and acquisition rates. We came with a sort of a nice middle ground number of $150 million would be our current valuation of the company. And I believe we were using the run rate of $50 million, not the projected $60 million sales for the following year, or the 12-month running sales revenue number of like 32 million. So $150 million was our consensus valuation of Right Now Technologies, with a range of between 100 million to 200 million, again given the industry average valuation multipliers from mergers and acquisitions. And we did look at the IPO multipliers as well, got a range, and they're pretty close, so between 100 to 200 million plus. So if Greg's investors are seeking 30 to 50% internal rate of returns, what exit value will they expect? And we've calculated a range, which is provided there, but between 355 million to 685 million. Based on that analysis, which option should Greg consider? And in order to get that 30% rate of return, that low end on the previous analysis, the only option that we find that would satisfy that would be the acquisition option at the 3 times the previous valuation rate, which would be to sell the company for $387 million. They can do that. $387 million will satisfy the VC's low end desire of a 30% IRR. And they could walk away with, I can't remember what the number was, but it was like $106 million for the VCs. Greg would walk away with a little over $200 million, and then there'd be about a $50 million pool to split between other shareholders in the company. If they did an IPO immediately, we're estimating that they could expect roughly $150 million based on those multipliers. And that's kind of the previous valuation we talked about. If they look to continue organically and maintain control of the company, and have that autonomy, we don't see them, based off industry averages and their estimated growth, being able to satisfy the VC's IRR demands anytime soon. So they'd be looking at a longer, obviously, a longer period before they'd be able to go to IPO or seek a valuation and a sale that would be comparable to what's being considered now. So that sort of summarizes our discussion. Any thoughts from the committee before we wrap this up? Anything I missed? All right. Stop screen sharing now. All right. If y'all are good with that, I'll go ahead and stop this broadcast.
Yeah.
Yep.